Okay, welcome everyone. It's right around start time here. First, I want to thank you all for attending. I'm sure by now everyone is very used to, and it's almost commonplace now using Zoom. So thanks for tuning in. Uh, we're excited to have you all. I will say we've got probably double the number of participants, if not more, than we've had in the past in our live presentation. So that's a good thing. Hopefully, when we're doing this again next year, it'll be under different circumstances, but maybe we'll want to include a Zoom feature to reach the widest possible audience. So again, thanks. I hope you'll find the next hour and a half, give or take, productive and useful. Just so that you know what the agenda looks like today. After a few introductory remarks, you'll hear from our guest speaker, John Medved, who I'll give a bio in a couple of seconds here. But John is in Israel. Just informed us that it's 110 degrees in Israel. So if you see him perspiring, it's not because of the questions. It's summertime over there. But we want to thank John for making the time and participating with us today. I know I'm very excited to hear what John has to say. It's very topical. You'll also hear after John speaks, and there'll be plenty of time for Q&A. And you'll probably see on the bottom of your chats of your Zoom screen, there is a function where you'll be able to submit questions in the Q&A feature. So we're going to let John speak for give or take 20-25 minutes, and then he'll be prepared to take Q&A. So if you've got questions that you want to tee up, you can do it during his presentation or when he finishes, and I'll transfer and transmit those questions to John. So please take advantage of that opportunity. You'll also then hear from our subcommittee chairs, which if you've been at any of our previous meetings, you know that pattern. So we'll hear from David Pulver, who will talk about our private equity portfolio. You'll hear from Jeff Bramer, who will talk about our public equities. And then Michael Weinstock, who is responsible on a subcommittee basis for our hedge funds and fixed income. There is in the materials, and hopefully you've had a chance to look at the materials that our consultants, Prime Buchholz, have prepared and distributed. So I want to thank them. They are in attendance, and thank them for their continuing good service, particularly in markets like this is when I think we find, having a consultant like a Prime Buchholz really serves all of us. Very important function there. So I want to thank them. There's also a listing of our investment committee members. Again, I want to thank them. Most of them have been with us for quite a long time. They're doing this on a volunteer basis, but they put in a lot of time and effort, particularly at the subcommittee level. So thank them, and we'll be meeting actually tomorrow night for our next investment committee meeting. And in particular, I want to thank Ken Hyman. Ken has been a long time, certainly a very important member of our community in so many different respects, but particularly on the investment committee here. And after many years, Ken will be stepping off the investment committee. Tomorrow will be his last meeting, but I want to thank Ken for all of his very valuable insight, and we will miss him a lot on the investment committee, and certainly hope to see him from time to time as well. So let me just start with a little bit of a snapshot of the market. And the first thing I want to mention is, if you notice in a footnote, our benchmarks. It's something that we struggle with in terms of what's the right benchmark for us to be comparing our performance, our different pool performance. And we did, as of the beginning of the year, revise our benchmark to more appropriately and accurately reflect the actual composition of the portfolios. I know there's always a question about looking at benchmarks, and this certainly was not a case of trying to cherry pick a benchmark, but since we have a significant hedge fund component and a smaller fixed income component and international component, we felt with Prime Buchholz's sort of oversight and approval that it would be appropriate to change slightly the benchmark. So just want to make sure that everyone understands when you see the performance numbers on a go-forward basis starting the beginning of this calendar year, there is a slight benchmark change. So again, just a very quick summary, and I'm sure you don't have to be a market guru to understand the difference between last year and this year and what's been driving markets both up and down this year. Last year, and again, you can look at the numbers, a pretty solid up year in terms of the, talk about the managed pool, up mid-teens, slightly underperformed the old benchmark. But again, this was a market that it's hard to remember in a sense, that market which was really upward and onward, low rates, low unemployment, continuing economic expansion, pretty much firing on all cylinders. For the most part, growth continuing to outperform value, and a lot of themes that we've talked about in the past that have continued and had continued at least through the beginning of this year, which again was a continuation to a great extent of, of the themes of last year. And then all of a sudden, COVID-19 hit. And since then, unfortunately, it's been 24/7 in terms of what's happening, what's the rate of infections, transmission, is there a vaccine, is there some other medication? And that's really been driving the markets. And I would say, from my own perspective, having been a market participant for many, many years, I think the degree of uncertainty in the markets and the sort of the looking at what's the next data point, out of, whether it's Italy or Korea or New York or New Jersey or California, what's the next data point in terms of a potential cure, vaccine, medicine, has really been almost overwhelming in the sense of trying to figure out, like, where should this market go? Of late, you've heard a lot of very smart market participants basically saying the market seems to be ignoring all the negatives out there: high unemployment, uncertainty about a recovery, forget about a V-shaped recovery. Are we in a U shape or are we in an L shape? And now people are talking about a W shape. Somebody was talking the other day about a reverse pie shape, the symbol pi. So everyone's trying to figure out, like, where are we going from here? And again, it's very hard to figure that out on a day-to-day basis. Our portfolios, and you'll hear more from the subcommittee chairs in a few minutes, are really designed to perform reasonably well in all kinds of market environments. And I think particularly when you have this kind of volatility, you have this kind of uncertainty, having a portfolio that's diversified, that has some hedge funds, has some private equity, has some non-correlated investments in it, you see the benefits of that. And it's not just, own an index fund, own an S&P 500 fund, and everything takes care of itself. I think this is when you see some of the benefits of active management. So we'll come back to a lot of that, and we'll certainly have time for Q&A after we hear from the subcommittee chairs. But now let me introduce John. And again, I want to thank John so much for participating in our event today. John, and you may know John by reputation. You may have even met him. He's one of the world's great entrepreneurs. And the Washington Post, back a few years ago, called him one of Israel's leading high-tech venture capitalists. Again, a few years ago, he was named one of the top 10 most influential Americans who have impacted Israel. So really just, an outstanding entrepreneur, founder and CEO of a company called Our Crowd, which I'm sure he'll talk about, which is the world's largest equity crowdfunding platform for accredited investors. And they've raised over $1 billion for over 170 countries since their launch in 2013. Some great quotes from the likes of Bloomberg, which says that our crowd has, quote, blown up the exclusivity around tech fundraising. The Jerusalem Post, it has taken Our Crowd only a matter of months to become one of Israel's most active funds. Goes on and on. And I'd rather hear from John rather than read his bio. The other thing that you should know, prior to Our Crowd, John was the co-founder and CEO of Veringo, a NASDAQ company, and the co-founder and general partner of something called Israel Seed Partners, which has around $260 million under management. So John, thank you very much, and we're delighted to hear from you. Stage is yours.
Thank you, Peter, and thank you, Michal. Thank you to everybody. I'm going to start sharing my screen right now, if I can here. And see, there it goes, and we'll see if it goes through. So I want to start with some comments about the state of what's going on here in Israel with the corona crisis, because the comments I'm going to make tonight are just completely influenced by this reality. It's pretty much on everybody's agenda, the major part of our lives today. Israel is on the other end of the curve. And if you look at how we've done, it's hard to say when you've had 272 deaths that you've done relatively well. But the answer is we have done relatively well. When you look at this compared to the number of Jewish deaths in places like France, where the number ranges between 1,300 and 2,000, or in England where it's approaching 400, or in New York and New Jersey, which you guys are unfortunately all too well aware of, these are really remarkable numbers. And when you look at how we stack up relative to the other 37 OECD, most developed countries in the world, pretty well in terms of testing mortality. Our mortality rate is only 1.5% of the tested positive cases. These high numbers in terms of total cases and total deaths are good, which means we're at the bottom half, of this OECD group. And here you can see some fairly dramatic proof of how we've come down to the other side of the curve. I mean, literally today, this was the headline as I woke up, which is that for the first time since the beginning of the pandemic, Israel has seen no new cases of coronavirus or deaths in a 12-hour period. Of course, as soon as that got published, they announced that we had, unfortunately, 4 more deaths and 22 cases. But I was able to catch this while the news was still very good. But in general, we're in a different situation. Our schools are all back to work full time. There's still some issues in terms of whether kids are going to be wearing masks in this 110-degree heat. But our schools are back, our companies are back. They're bringing back next week restaurants. They hadn't officially brought back the beaches, but you might have seen the pictures. In this heat, there's no force on this planet that can keep Israelis from the beach. And God willing, if we stay with these low numbers, then we'll start working on the real challenge, which is bringing back the economy. And the reality is that, this pandemic is not the world's first rodeo, as it were. We've had them for years since the, Spanish flu, and, you can go all the way back, I guess, to the Black Death and things like that. And this is unfortunately not going to be the last. The problem is, how do you deal with it? And how do you tackle these global challenges? And Israel is uniquely suited, I think, to really thrive in this environment and to play a major role. It turns out that, when I did presentations like this and tell people about the startup nation a decade ago, I had to use, a slide like this from the Israeli embassy or from the World Zionist Organization. Now I get to go to those guys from Davos. They do all the work for us. I mean, literally ranking Israel #1 in areas against all the countries in the world of growth of innovative companies and R&D expenditures and entrepreneurial culture and companies embracing disruptive ideas. Israel rocks the world. And you can see it in numbers up through and including the data on the first quarter of this year. This is an extraordinary chart of how much money has been invested in billions of dollars in Israeli startups through most of the last decade. And it went from 2 and change in 2013 when our crowd was started. We can't claim responsibility for this. We played a major role, but we had a very, very good sense of timing where we really started at the beginning of the staircase. It got to 8.2 billion last year. And this first quarter, we were on track for over $10 billion year. I got news for you, we're not gonna make it. Okay, because obviously we're being hit by the crisis, and we'll talk about how that hit works and how it affects certain companies more than others in a big way. It turns out that when you're in a downturn, especially in the venture capital asset class, which is sometimes viewed as not correlated, but it also is affected by overall conditions, the traditional best performing venture vintages, the years that venture funds that outperformed were in these financial downturns. So you look at the top quartile IRRs and returns from people like Cambridge back in the financial crisis of 2007 to 9, or back in the internet bubble blow up. It turns out that those who began to invest in towards the end of the crisis actually had a great fortune. But this time, it turns out that it's not just a financial downturn that makes the investment environment so interesting, but the fact that we're also at an inflection point where there is a huge set of changes going on in culture, in civilization. I think it was the head of Microsoft who just recently said that in the last 2 months, there has been 2 years of digital transformation. And I think, by the way, he understated it. I think there's been probably like a decade of transformation. And it's not just Zoom that we're all taking for granted, but people are asking questions about, well, do I really need to travel so much in the future? Do I need to go to my office? Do I need to show up at university? I'm sure some of you are having those conversations with your kids about the fall. And we are not going back, no matter what happens, to a status quo ante lifestyle. It's not happening. There will be a new normal. There already is the emergence of that new normal. And this presents huge opportunities for venture capital. And it's not just a reevaluation of what's going on in the medical environment. For example, vaccines were probably the one word you could use to make a venture capitalist yawn and close his eyes. Nobody was investing in vaccines years ago. Same for diagnostics and testing. It was like the wasteland of venture capital. That has changed completely. Everybody's looking for deals. And what this is going to do to medical investing in general is drive huge amounts of money and huge amounts of attention into that sector. But it's not just about the medical changes. It's again about these distance-based services, about business continuity, robotic process automation, which means letting bots do the work instead of coders. It's about risk mitigation. All of these things are going to become very, very important. And these trends are now really accelerating into warp speed. So this becomes a very, very interesting time to be looking to enter the venture capital marketplace. Now, there are going to be winners and losers, right? The winners we just talked about. Anybody doing virtual services and health tech and whatnot. Losers are people who are doing like shared offices are having a real tough time now. The oil industry coming back a little bit, but still in grave issues there. And there'll be sort of reimagined and reset industries, because we will travel again, but not in the same way. And the way that we approach wellness and health is going through a complete reevaluation. The biggest accelerant here, what's going to change everything, is going to be artificial intelligence. Artificial intelligence will affect everything, will drive whether it's the next wave of the mobile revolution in 5G, whether it's what's going on the processor side, where we're moving from the traditional CPU to what I would call the intelligent processor. We're leaving even the GPUs behind. It's about Internet of Things, about big data, and about the cloud. And at the heart of it is AI. Now, the good news is that Israel is an extraordinary world power in AI. And you can see this here on this data that literally Israel, at least as of about a year and a half ago, was duking it out mano a mano with China for the #2 slot in terms of a country with AI startups. And this isn't on a per capita basis. This is on an absolute basis. I mean, when you begin to understand that Israel and China had the same number of startups, I need to get this data updated, but it's pretty amazing. And if you just look at what's going on in Israel relative to the virus, there are dozens of new testing companies. Here's a sample of them. There are dozens of new therapeutics being developed and affecting stock prices. There are people building ventilators out of, essentially junk, as well as designing it from scratch. And of course, there are now 4 live vaccine developments that we know of in Israel, including one that we're backing ourselves, which we're very excited about, called Medved, which is a story in and of itself. You might have seen the news in the New York Times that we just announced a $12 million investment here. This is a group that comes out of a research institute in the north of Israel called Migal, with close to 400 researchers up in Kiryat Shmona, would you believe. And they were tasked by the Israeli government over 4.5 years ago to basically solve a chicken flu problem that was killing the chicken coops all over the country, and that the most effective commercial vaccine, would you believe, was only saving about 10% of the chickens. So they said, you guys figure that out. You're smart guys. You've got bioinformatic, design tools. Get it going. And they started working on it. It turns out that the bug that was affecting these chickens was a coronavirus. And they developed a vaccine for the chickens, and they started testing it through 2018 and 19, and the results were extraordinary. Literally, they finished the tests about a few weeks before COVID was announced. And when COVID-19 showed up, they said, wait a minute, we've got something here which we can modify quickly. It's already been proven to work in chickens remarkably. Let's get it to work for humans. So we jumped on this. We're very excited about this vaccine. In terms of its advantages, it's an oral vaccine. One of the two of the, there are 100 programs out there. I'm sure you guys saw the news today on Moderna, and we're rooting for them for a variety of reasons. First of all, that, mankind needs a vaccine. I don't care who brings it, somebody should bring it. But Moderna happens to have a chief medical officer by the name of Tal Zaks, who's an Israeli, who spoke live on Israeli TV tonight in Hebrew, which was really cool. That was the top of the news about Moderna's early progress with their trials. But the advantages we have is that we're oral, we're not a shot. This is a vaccine that has already worked for a similar coronavirus, and it doesn't use any part of dead or live virus, so it can be used for people who are immunocompromised. It turns out that it's pretty easy to manufacture because it's about fermentation, and it's really good at mutations. So we're very keen on this, and we'll be in mammal testing in about 2 weeks, and we hope to start human testing in the summer. We're behind in terms of the timing for people like Moderna and others, but we believe that there will be several winners, and whoever gets an oral vaccine will ultimately win, because they typically trump everything else. It's easier, especially for the third world. So it's a big market, and we're hoping that many of these vaccine programs work. That's what's important for the world, and we're very proud to be investing here. We're also actually investing in a bunch of other companies that are engaged in this fight, either directly or indirectly, and I'll go through them quickly, and then maybe we'll spend some time chatting and asking questions about the overall situation. This company, Site Diagnostics, was actually dubbed in the press as the anti-Theranos, because they have done what that other company talked about doing, and they've got an FDA-cleared product which takes 2 drops of blood and in 10 minutes gives you a digital readout of a complete blood count. And it turns out that you need to do CBC or complete blood count for COVID patients as soon as you know that they're infected, and they don't really want to commingle that blood with the central blood laboratory. They'd much rather have a point-of-care box, which Site has, in a small form factor sitting in a quarantined area, and they can actually even use it to bring to a patient's home where they can get CBC testing before even getting chemotherapy in an ambulance. It's quite remarkable stuff. Right now, it's a $50 million round being led by a huge medical company testing leader in Site. And we're very excited about what they're doing. Pulm1 is a company that focuses on pulmonary lung function testing. And it turns out, unfortunately, the people who have recovered from the virus, especially those who were on ventilators and were lucky enough to come out of it, but even others who are even just moderately affected, are probably going to have some lung impairment. And this is a revolution in lung function testing, because instead of having to step into what looks like a British phone booth and is called a body box, which is really expensive and only in hospitals, you can get this lung function testing at your local GP and in seconds, minutes. It's really quite remarkable. Very excited about this. TytoCare is a company which is giving telehealth a new name and a new look. It turns out that this is clinical grade, real diagnostic equipment that you can stick in your kid's ear safely or down their throat or in their nose, because it actually guides you through an AI image guiding system to where you need to get the image. And once you get these images, you also get lung sounds and heart rate and all kinds of other data from this little kit. It then gets transmitted live to your doctor or to an AI and can provide a remarkable degree of remote care. And this company is on fire now because this is, where we're all headed, which is, hospital at home and remote care of patients, big area. They just raised $50 million in a round led by Insight Venture Partners. Intuition Robotics, you might have seen in the news. I mean, normally I would show video clips, but it's still not, Zoom isn't good enough yet to really show these clips in high quality. So maybe when I send out the slides, and there'll be an email address at the end of this for you to send, if you'd like a copy of the slides, I'll put links to video clips so you can see them. This is a company who has invented a intelligent, empathetic digital companion for the elderly. And it's, it was important before COVID, but now it's become obvious how critical this is. It's just such an unbelievable thing where there's a video out from a couple of days ago from an 85-year-old who says, it's a technological marvel. Basically, any person, old or young, can talk to this robot and it understands them. Okay, you don't have to give it a scripted prompt like on a Siri or a Alexa. You can have a free-ranging conversation, and it helps the patients or the elderly people stay in contact with their family, to text and to get news and pictures. But more importantly, it can remind you to take your meds, to drink water, and it's really an extraordinary product which we think has a huge future. Cryon is a company doing this incredibly important buzzword. If you want to be buzzword compliant, learn this word, robotic process automation, RPA. It basically means that instead of using hand-done software, you get bots do the work for you. And why it was so important for COVID is that in Israel, we moved very quickly with our testing regime and whatnot. And we have some very big health organizations, such as we call them the Kupot, or Kupat Cholim Klalit, or Kupat Cholim Maccabi. These two organizations needed to hook up the COVID testing data to their central databases. And their engineers said, okay, 2 months, we'll have it ready for you in 2 months. And the management said, no way, we don't have 2 months, we need this hooked up today. So they found their way to Cryon, and literally within 48 hours, it didn't take 24, but in 48 hours, the bots were able to do that, and it's been working like a champ. They're also helping people file unemployment claims and whatnot. It's an amazing company. And you'll be hearing a lot more about it. Medved is a company where actually one of the largest funders has been the US Department of Defense. And they have given this company a lot of funding because they have technology which can determine quickly by using AI whether or not your infection is viral or bacterial, which is important to all of us, especially when your kid at 2 o'clock in the morning is screaming about an ear problem. But it becomes really important in the COVID era because what they're doing is studying immune system response. And because that's what they're taking their cues from, they think they can do earlier detection of COVID-19 than almost any other methodology by watching the very early response of the immune system. Pretty amazing company. VocalZoom is building a sensor array, which will include not just temperature, but also heart rate, breath sounds, a whole bunch of things which can be done remotely at distance in airports. So you can get a real picture of what is going on in all of these people going through your public space. Switch is a disease management platform that was developed initially for diabetes, moved to oncology, added oncology, and now is adding COVID. So the management is done via cell phone, where basically it reminds the patient not just about their medications, but their steps and what they're eating, and it's a holistic approach. What makes this more than just another wellness app is this has actually been tested and proven at Johns Hopkins University, where they found some remarkable clinical results here. Barcode Diagnostics is a company that is nano-coding chemo candidates, so you can inject it into a patient with 3 or 4 potential candidates, let it go to work for 2 or 3 days, and then do a biopsy and see which one is working best. And this is, pretty big technology for oncology. Was published in Nature, but now they're using that same encapsulation technology to speed up this PCR testing, which we're all crazy about being used as the backbone of the COVID effort for diagnosis. And it can speed it up by 2 orders of magnitude, by 100 times, by basically coding the RNA fragments, and then they basically get amplified as a bunch. And it's pretty remarkable stuff. Data.World is not an Israeli company. It's an American company. And one of the things important to point out is that while we're headquartered in Israel, we have offices all over the world in 13 different cities. And we're investing now over 40% of our dollars outside of Israel and building a worldwide network, including a lot of great American and other countries' companies. So Data.World is based in Austin, Texas. Great guy named Brett Hurt, who has been a very successful entrepreneur. I met at a JNF breakfast in Austin, and then met again at APAC, and we closed the investment deal. And they're probably the world leader in aggregating disparate kinds of data. They're taking data from all kinds of different feeds, putting it together. They've got a community approaching almost 1 million data scientists. If you know a company called GitHub, they're like GitHub for data science. And they're focusing on COVID, and it's just an extraordinary company which will soon be launching sort of an Amazon for data site, actually raising money for them right now on our site. TechC actually got some great press in New York because one of their new customers is Verizon, who actually took this product into their ensemble during the crisis because they had a major problem. Look, today you can't have, or you couldn't have until we reopen, a Verizon tech come to your house. And yet if you're losing your TV or losing your internet, you're probably losing your mind. And so you got to get some kind of tech support. So it turns out that these guys are using artificial intelligence to give you tech support via the cell phone. You can use your cell phone and aim the camera at whatever it is that's ailing you, and their either AI or live assistants will guide you. And Verizon has been using this very effectively, also Vodafone in Europe, and it's remarkable. They're actually using it for technicians who want to fix ventilators, who don't want to have to go into a hospital. CyberMDX is a company focused on cybersecurity for hospitals and for medical devices. One of the great fears we have of the current situation is that you might have been reading that hackers are really targeting our hospitals and developers of vaccines, and they're doing it either to steal or to ransom. And the danger in the near-term future of people getting a note saying, look, I've got control of your pacemaker or your pump or your ventilator, and you've got 30 minutes to live unless you send the $1 million or $5 million to this account. This is not something from James Bond. This is real. And CyberMDX is here to prevent that from happening if you use their software. They just raised a $20 million round a couple weeks ago, middle of the crisis. Sense Education, another company based in Israel with offices in New York, doing amazing remote testing for the distance learning market. Look, there were 1.5 billion students at the peak who were out of school. We all understand how important distance education is. And Sense is doing a remarkable job. A guy named Seth Haberman sold his last company to Comcast, is running it out of New York. Spectacular. and very excited about that company. In terms of just a few words about our crowd, and then I'll take your questions. We're the most active VC. We're not a fund. We're the VC platform in Israel. We allow people to either choose individual companies like the ones you saw and invest in single company venture funds, or you can buy pools and indexes that either are sector or stage focused and whatnot. We're getting a lot of business done even during this crisis. These are some of the companies that have been raising significant money. We mentioned Site, BioCatch, another company out of Israel in New York, just raised actually we shouldn't be showing that slide. That's some stuff a little too proprietary. Here's our crowd portfolio, which you can see is very, very, I think very diverse, ranging from healthcare to semiconductors, cybersecurity, cannabis, food tech, enterprise software, consumer hardware, and fintech. A lot of companies, 200 companies in our portfolio. We've had a bunch of exits, actually up to 38 exits, and a bunch of important IPOs. We were private investors in the company Beyond Meat that's gone wild as the interest in plant-based protein goes up. We were investors in a company called Jump that was sold to Uber. And so we actually had Uber stock at a reasonable price before the IPO. We sold last year Wave out of Canada to H&R Block, and we've had a bunch of really good exits, and we've got a lot more to come. We just recently announced a partnership with Stifel, who is a major investment bank all over America, I think the 7th largest broker-dealer with over 2,000 advisors, and they're now offering our crowd products to their individual investors around America. They're distributing both individual deals as well as funds, and we're cooperating, and they made an investment in our parent. I'm not going to talk about this index fund. This is a very sort of interesting index fund that's got 50 companies in it. We can talk and share results if you're interested. But I think at this point, maybe it makes sense to turn it over to some questions so we can have more of a dialogue for the few minutes we have remaining. So if I can look at the questions here. I think I can grab them. Or well, you can read them to me.
I think I'm going to see the questions, John. Hopefully we'll get some. I know I've got a bunch of them. First of all, thank you. I mean, it's fascinating. The breadth of your portfolio is pretty amazing. And just the number of things that you're looking at is truly staggering. So let me just look at the first few questions, because I know I've got a bunch.
So,
I guess
so I see one question here, okay. Peter, about our differentiated approach to venture investing.
Okay, and, go ahead. Yep. We have first. John, just read the question. I'm not sure if the audience has it, so just read the question, please.
So can you tell us more about the differentiated approach to venture investing, namely crowdsourcing? What have you found are the pluses and the minuses? So, look, I ran a pretty normative venture capital fund for 11 years. And venture capital has been an incredible asset class. It's consistently out-returned almost every asset class, especially is if you take a 20-year kind of approach. Venture doesn't happen overnight, right? You're building huge returns by taking a lot of risk. The way you take that risk is you build portfolios. But until we came along, and a few others who were doing some of the stuff that we're doing, this was basically not for hardly anybody. I mean, maybe a couple of thousand investors in the world could play venture. And the reason is that most of the venture funds that you'd want to invest in required a $5 or $10 million minimum. And that means if you wanted to put together your own sort of group of managers, 4 or 5 of them, that meant you really had to invest like $25 or $50 million. And any kind of asset allocator, and I'm sure there's a bunch on the line with us now, knows that you shouldn't have more than 5% if you're a crazy cowboy, 10% in this kind of asset, which means that you had to have basically $500 million or $1 billion to even get into this game. And that's why most people never played it. And you look at the, 14 million or so accredited investors in America. To be accredited, you need $200,000 of annual income or $1 million of investable assets outside of your primary dwelling. About 99% have never made a venture investment, either into a fund or to a individual angel deal. Now, that was okay in a world where companies would go public early. But when you have a situation where there are over 500 unicorns, and they're not rare like they were supposed to, companies wait forever to go public. And now you're being told, okay, buy into Uber at $70 billion and you get the upside. Now, I'm rooting for Uber, nothing against it, except that's not the same investment that you had when you were offered at the IPO. Microsoft, Amazon, Apple, or Oracle, they were all $1 billion or less. Because those investments, if you did them back at IPO and rode them to today, you're talking about 1,000 to 2,000x. Okay, literally, if you would put $1 million into those investments and held on, you became a billionaire. Okay, and that's what stock markets were supposed to do. But they don't do that today. So everybody, I think, realizes that the money is being made in tech disruption and growth, but it's being made when these companies are private. And if you're locked out and you can't pick up your phone and call your broker at Morgan or Stifel or Merrill or whatnot and say, buy me that hot Medved startup in Israel, or buy me Data World out of Austin, then what the heck do you do? Well, so you wait and you figure out if you know somebody, if you know a Lee Lasher in your neighborhood, maybe it'll connect you to something, okay? But it's not a scalable situation. Okay, Lee, by the way, is one of our good friends. And so the reality is that we set this up so that people could connect initially to Israel, because we felt that with so much interest in Startup Nation around the world, why shouldn't people be able to invest $25,000 or $50,000 or $250,000 or $5 million in a variety of well-vetted, well-chosen companies where the GP was putting his own money in the game, managing it, and you could pick them like you pick stocks. And so that's what we set up and did it 7 years ago. We're now at about 1.4 billion in commitments. We have 200 companies, 22 funds, 38 exits, and it's been a heck of a ride. I mean, Israel has really been an amazing place.
So John, let me just pick up on that. I mean, the universe of potential investments is large. And you might even say, look, everyone's focused on coronavirus today. How do you pick the winners from the losers? How do you do due diligence on so many things going on? And how do you keep track of, this rather humongous portfolio that you have going on here?
So first of all, you have 150 people working for you. Okay. We have a very significant team. We've raised a lot of capital, to build this platform. You also then hire 30 programmers who are writing software. We're a fintech. For the last 6 years, we've been in the top 50 fintech innovators according to KPMG worldwide, because this is about essentially using technology to disrupt the venture market a little bit and to democratize it. But the key element that we believe in very much more than almost anybody is diversification. In venture, you never know that today's hot trend is going to be dog food in a year or two from now. Use, for example, autonomous driving as an example. We were as excited about autonomous driving as everybody. I actually was guest hosting a Bloomberg TV show with Betty Lou, and the head of Audi came on in 2000, I think it was 16, and started talking about their autonomous driving program. I said, okay, Mr. CEO, I forgot his name, when are you going to be launching your first fully autonomous car? And he says, oh, the end of 2017, 2018. And I looked at him, I said, no way. He goes, no, we're for sure. And, look, time has told that we all know now that autonomous driving, fully autonomous driving, is years away. People are running out of their homes in Chandler, Arizona, with baseball bats to bang the Waymo things that are endangering, God forbid, their neighborhoods. Okay, and you couldn't have seen that, right? Most people didn't see that coming. People were crazy about cannabis a year ago. Stocks were rocking and rolling in Canada. Oh my gosh, cannabis is going to be the next, and by the way, we invested and have good investments and made money in autonomous driving and in cannabis, but you never know. So you have to be diversified in multiple areas. I think that healthcare and digital health are long-term secular trends, and you'll be good, but also cybersecurity is important, and artificial intelligence is important, and the future of manufacturing we call Industry 4.0, and data-driven agriculture, and drones, and sports tech, and food technology, and it goes on and on. So that kind of diversification is critical. You can't pick one or two startups. You got to have a portfolio, because you need more shots on goal, because a goal here doesn't get you 1 point. It should get you 10 points or 20 points. You're looking for 10 and 20 X's. And unfortunately, in venture capital, you get a lot of zeros, especially if you're early stage. So what we do is we provide multi-vector, if you will, diversification that gives you the ability to add companies or funds in all of these different sectors, as well as different stages. You can invest in the earliest stages, you literally from incubator stage all the way up to pre-IPO stage. And that kind of diversification works, creates a major mitigation of risk, and gets you a lot of shots on goal, which is going to give you the returns for which venture capital is known for. And so,
go ahead, finish. I was going to say, so Zan, to pick up on that, I mean, do you think that like people focus on what's happening, the newspapers, the media, obviously COVID is, again, it's 24/7. Is there a risk that, there's a COVID-19 bubble in the sense of everybody wants to put money in everything, everybody's focused on that. And, maybe we get a vaccine in 6 months or a year and it's like, the world is different, but it's not so different than maybe it was, 6 months ago.
Look, I'm not going to comment on whether Moderna is worth $30 billion as of today's market cap, or that Novavax, has, the NVAX symbol, that company has gone up in literally weeks, tenfold. Okay, it went up another 13 points today. Okay, these stocks are getting awfully exciting. Okay, and a lot of momentum behind them, and there might be a bubble. Okay, but on the other hand, if you have something which saves humanity, it's probably worth a lot of money. Okay, and if these guys get it right, they're going to be able to, I think, return, great sums. But I look way beyond COVID, because this is our new reality. This happens to be a particularly virulent and dangerous and weird and unknown virus. And the more we know, the less we know, right? This thing is really, we're learning and we're innovating faster than ever, but we're still in the dark, big time. Okay, all this stuff that's coming out now about children is freaking me out, should be freaking everybody out. Okay, and it's new stuff. So I think that long-term investing in technology, in medical health, in food health, in agriculture, the supply chain, this is going to be where real great money is made. And you're going to have to add part of your portfolio into private companies. And what's happening is that the big banks are realizing this, and they're starting to say, okay, now how the hell do we, how do we provide venture capital to millions of investors? Because this has been something so esoteric and so closed. How do these guys begin to handle down rounds? How do they handle follow-ons? They don't even speak the language, like preemptive rights and pro rata and, liquidation preferences and anti-dilution. I mean, it's a whole different language. And you think you're a financial expert, you play the market, you work hedge funds, and these guys know nothing about venture. Okay, because venture has been this little esoteric coterie. but it's going to be broken open. We're doing, I think, a pretty good job. We're up to about 50,000 registered accredited investors worldwide, making a lot of noise, getting a lot of attention, and we're making good investments. And our results, you know, when you look at our aggregate and you put them together in funds, we're pretty much tracking top quartile performance from Cambridge. So we're doing well, but we're doing it in a way that actually adds value to the companies, because the thing in venture capital is there's still a lot of money out there. Even though the market is now taking a gut punch, and a lot of venture capitalists have said, wait a minute, I'm going to reevaluate, I'm not rushing into anything. There is still tons of money, lots of liquidity in the market. And the issue is making sure that you find good companies and you've done your diligence and you've done your work, but more importantly, adding value to these companies. Because the companies the good ones can pick their investors. They're no longer delighted when an investor shows up with a term sheet. They say, oh, God bless you. Thank you for investing. It's like, what can you do for me?
Mm-hmm.
How can you help me on my board? What can you do to, you know, introduce me to key customers? How do you help me raise more money? How do you help me go public? How do you help me, you know, get media coverage? And it turns out that because we have these 50,000 sort of motivated investors, we can add more value than almost anybody. And especially when we mobilize them around Israel, because the majority of our investments are in Israel. And, you know, while we have investors from every country in the world, right? We had our live event in Israel, the summit in February, just before everything shut down. We were like the last major event in Israel. We didn't infect anybody that we know of, God willing. And 23,000 people registered for this summit.
Wow, yeah, that's
you
impressive.
know, so this is a horde that when you get it behind one of these startups, you help it get above the noise level. And that becomes a real strategic asset and works as sort of a positive feedback loop that gets us good deals.
Well, John, thank you. I wish we had more time, and I wish it wasn't so late over there. And you could stay with us, but thank you so much. I mean, it's fascinating, and really, again, want to thank you so much for staying up and bearing with us, and just a fascinating discussion. So, thanks, and I'm sure all of our participants also would give you a virtual set of applause here. So, appreciate all your
what
help.
I want to do is I want to show you. I think I'm still showing slides. Is that correct?
I believe so.
Yeah, I'm going to show you just one last slide.
Okay.
And that's where if you would like to get a copy of the slides or any further information, we created an email box for your listeners, jcfwebinar@ourcrowd.com. Send us your email and we'll send you the slides and we'll, you know, stay in touch with you. Okay.
Great.
And we'd love to be able to hear from you.
Thank you. And if anybody didn't get that that address, then Michal will be able to provide it. So again, thanks so much for all your help, John.
A pleasure. Okay.
Be well.
Thank you.
Thank you.
Bye-bye.
Okay, thank you all. Many thanks, Peter, for your investment insights and review of the current market, as dynamic and volatile as it is, and especially to John, our guest speaker, all the way from Jerusalem. I actually had the pleasure 2 years ago of attending the Our Crowd Summit. It was quite the event. What I'd like to do in the next minute is to just give you a quick overview of JCF. I have the honor and pleasure of serving as the president of the board of the Jewish Community Foundation. For those of you who are not totally familiar with it, JCF is the planned giving arm of the Jewish Federation of Greater Metro West. In terms of size, 2 months ago, I don't know what the number is now, we were managing close to $500 million in donor assets with more than 800 individual funds, and in particular, a growing donor advised fund program. One of the other highlights of what we do is we have a Center for Strategic Philanthropy, and with that group, we offer strategic, multi-generational philanthropy through a Jewish lens. It's really an important differentiator for how we do donor advised funds, supporting foundations for our customers. In 2019, our fund holders granted $34 million, including $2 million to our annual UJA campaign. And more recently, Our fund holders have already distributed more than $2 million in response to the COVID-19 needs in the community, nationally and in Israel and around the world. So that's it for the commercial for the JCF. There are plenty of ways you can get contact with us. It's now my pleasure to introduce the next section of this presentation, the subcommittee chairs of our investment committee, who are going to give their reports. All three of them are going to magically appear on your screen. First, we have David Pulver, the private capital subcommittee chair. And then we will have Jeff Bramer, the public equity subcommittee chair. And last but not least is Michael Weinstock, the subcommittee chair of both flexible capital and fixed income. And now I'll call on David to take us home.
Hi, how are you? I guess I can't hear you. Anyway, I chair the subcommittee, which is private capital. For us, private capital actually doesn't include venture capital for all the reasons that John talked about. It's a really difficult area, and it's just it's a interesting area, and it's something we're looking at, but we don't do right now. For us, private capital includes two basic areas. One is private equity or buyout funds, and the second is private real estate. And one of the questions is, why invest in private equity? The answer is to seek higher returns. Not quite like a venture capital would seek it by getting a lot of shots on goal and hoping, some of them really give you a 10x or a 20x. Ours is a little bit more conservative. And the issue was why doesn't everybody just do venture capital? What do you have to, in effect, pay to get those higher returns? And the answer is illiquidity and more potential risk. As far as illiquidity is concerned, when we make a commitment to a private equity fund, the expected start to finish time is anywhere between 8 to 12 years. The fund draws down our money over a 3 or 4 year period as they are making investments, and then they operate the companies, or in the case of real estate, the real estate assets, over a 3 to 5 year period, and then they sell the companies or real estate assets. There is a secondary market if you want to sell early for these illiquid partnership investments, but generally the discounts to sell the partnership interest is unattractive. So it is an illiquid long-term investment. As far as the potential risk is concerned, generally the success of the investments is a function of improving the performance of the companies or real estate assets that are acquired, and of course, leverage is used. What this leads to is a wider dispersion of returns in private equity. This means that the performance between the best private equity managers and the worst private equity managers is larger than the fund managers, that manage marketable securities. In addition, the median private equity manager returns are only slightly better than the median returns from marketable security fund managers. So the key to success in private equity is in identifying and accessing the best managers. It takes work and it takes patience. We are hard workers and we are patient in building our private equity portfolios. We also, and this was mentioned by John, we also want to build portfolios that are diversified. In the kind of private equity that we do, there are several different types of funds that are that we include in our funds. One is a traditional private equity or buyout funds. We also have growth equity funds, predominantly tech funds, not venture funds, but later stage tech funds. Distressed funds is another one, and secondary funds is another one. In private real estate, the areas include industrial real estate, residential real estate, office, hotels or hospitality, and retail. We also try to diversify in other ways, one by size of fund, large funds, medium funds, smaller size funds, and also domestic and international. So we do all that in order to build a portfolio. I want to share a little history of our private equity capital investing. We started our programs in 2005 and 6, 2005 for private equity and 2006 for real estate. Let me first give you a little feeling about the private equity history. In 2005, we started by investing mainly in fund of funds. Although we knew there was a double layer of fees, the fund of funds fees and the underlying fund fees, we gained immediate diversity, which was important to us. We did that for about 3 years. In 2008, we were ready to go direct and eliminate that extra layer of fees, which, by the way, was about 300 or 400 basis point drag on the returns. At about the same time we were ready to start direct investing, the global financial crisis occurred in 2008 and 9. This delayed our plans. So in addition to trying to access hard to access funds, which normally raise funds every 3 to 4 years, we had to deal with the global financial crisis of 2008 and 2009 and the delay in raising funds due to that crisis. This delayed our process. In addition, we were having problems accessing the hard to access funds. These were funds that were oversubscribed. We were not going to invest in funds just to put the money out. We really had to believe in the funds in which we were investing. We were persistent, kept knocking on doors of the funds that we wanted to invest in. We needed them at that point more than they needed us. To help our case, we said we were investing on behalf of a worthy charitable institution, and we're a small investor which they could hopefully squeeze us into their fund. Anyway, as we accessed more of the hard to access funds, it made it easier to access other hard to access funds. So we are finally developing a robust program. Our target allocation is 14% of the total investments in the private capital area. We ended 2019 at 10.1% and are projected to be at 13.7%. This is against the 14% target by the end of 2021. Most of that increase is because the funds in which we currently invest their funds over a 3 to 4 year period. So it takes a while for the money to be invested. We are also focused on investing in growth equity tech area, which we think is a very good area over the upcoming period. During the recent 2019-20 period, 3 of the 4 commitments we have made have been in this growth equity area. And the 5th investment has been in the distressed area, which is a nice space to be in given the COVID-19 crisis. Our more recent returns, and these are as of 3/31/20, which includes just a little bit of the COVID situation, are as follows. We look at it from a 3, 5, and 7 year period. We don't go less than 3 years because it takes a while for the money to be invested and for us to find the funds, invest the money, and so on and so forth. And so our 3-year return has been 15.2%, 5-year return is 15.7%, and our 7-year return is 15.1%. The 15.2 was slightly below the benchmark return of 15.3. That's the year, and the 3-year number. The 5-year number, 15.7, is above the benchmark, which is 12.7, and the 7-year, which is above the benchmark of 13.8. We're 15.1 versus 13.8. And part of the reason, particularly in the younger funds where we're slightly behind the benchmark, is that we have a greater number than the average fund in the benchmark of newer funds. And it takes a while for these companies these funds to invest in these companies and then to impact the performance of these companies and then ultimately realize the return. It's referred to in the industry as the J-curve effect. So that's our story in private equity. It's a little bit simpler in real estate. Real estate was a different situation. We started in 2006 and were able to gain access to Blackstone Real Estate, which is one of the best real estate funds available. They also invest in all real estate categories that I previously mentioned, giving us an instant diversity that we were not able to get in private equity. Our target allocation is 7%, and we ended 2019 at 7%. and we were projected to be 8.7 by the end of 2021, which is a little higher than our target, but comfortably under the upper limit allocation of 10%. As respect to the returns as of 3/31/2020, again, we have 3, 5, and 7-year returns. The returns are in the 3-year period 15.7 versus a benchmark of 12.7. The 5-year returns are 15.1 versus a benchmark of 13.8. And the 7-year return is 15.4 versus 10.7. Anyway, I just wanted to give you a little sense of what we do, the history of how we got to where we are today, and an update on the returns that we've had. And that's really my presentation for today. Any questions would be happily accepted.
All right, thank you, David. I'm going to pick up now. This is Jeff speaking on the equity side of things, the public equity side of things. And you've heard me talk much about this in the years past. So more broadly, let me just cover sort of our broad philosophy and some changes that we've made recently and some new ones we're planning to make going forward. So in the public equity space, we're also long-term investors, although unlike the private side, is very liquid. And we try to look for the capital appreciation that we can get from equities with consideration to the risks that equities bring to you. And broadly speaking, we're trying to balance the short-term movements against our long-term focus. And the current market is nothing but lots of short-term movements in every different direction you possibly can be. I've heard a lot of different, Peter mentioned earlier, a lot of different ways people look at the market. I tend to think of it more like the Charlie Brown t-shirt approach, where you see this line moving rapidly and quickly from one side to the other. So you never want to move quickly one way or the other, or to zig when the market's zagging. Part of the reason why we look at that is have our long-term asset allocation plan, but use active managers who can move in and out of certain pockets of defined areas. Now, as a broad base, we like the idea of tilting the portfolio towards value companies, longer-term nature businesses. We prefer having some exposure to small cap and emerging markets. And part of the benchmark change that Peter mentioned earlier was so that we reflect that in our broad portfolio as well as in the benchmark. There are times where active management we think works very well, and there are times where passive can be a useful tool. And a few years ago, I told you we had moved some of our large cap money into a passive mandate, helps lower the costs, gives us exposure, and somewhat also mitigated a bit of our value bias, which has been a tough area to be recently, as the markets have really been driven by a handful of large growth stocks, no matter what part of the market you're looking at. But broadly speaking, I'm thinking global markets. But as you've probably heard, the FANGs and other sort of acronyms have really driven performance. Now, recently, the other thing we also look at is think about where the opportunities have changed. Sometimes that might be with an individual manager. We've had value managers that have done well and others who have actually not produced the sort of downside protection or out of sync performance that we look for. And we've made replacements. We took out one of those managers earlier this year, replaced it with another. That was for performance purposes, where we really felt like that has somehow gone from being a short-term nature to a long-term trend with that particular manager. With our consultant Prime Buckles, we also monitor managers for personnel changes. One of our emerging markets managers had a significant change among their senior management, and we did a search and replaced that manager just last month. Now, these current environments have thrown a lot of things around. One thing it's done is actually created more opportunities for some of our managers and more opportunities for us to access managers who previously had closed. And we see that across the board. One area where we're looking at is in the international equity space, where we are evaluating some additional managers that have recently become open for new assets that they weren't previously. And we may have an opportunity to sort of upgrade parts of the portfolio as a result of that. And then lastly, sort of looking forward, and because it was a question on last year's in-person discussion, is we've been taking another look at the idea, this umbrella of what's called responsible investing. And you may have heard the terms ESG for environmental, social, and governance, and how that can fit in beyond just sort of asking managers how they look at that, but how we might, as a investment committee, think about that for our structure within the JCF and other mission-related investments we can do. we actually had some discussions about this internally back in February. But then before we could go much further on that, the world changed a little bit, and we'll come back to that now as things settle down a bit more. But broadly speaking, we have our long-term focus. We have to keep in mind whether that's the short term is moving into the long term, and what we should do next. And we're trying to sort of make those with a view that says what will preserve capital and protect your assets, and will also allow them to grow over the long term.
Thank you very much, Jeff. My name is Michael Weinstock. I'm in charge of two different subcommittees, the Flexible Capital Subcommittee and the Fixed Income Subcommittee. My day job is I manage a money management firm that manages $5 billion of assets focused on distressed debt. In the first category, flexible capital, when we say flexible capital, we're referring to hedge funds. Our goal in hedge funds is to earn reasonable returns, but take much less risk than a portfolio of equities. And this year thus far has been a test of that strategy. And while the hedge fund portfolio has lost money, its losses have only been half of what we lost on the equity portfolio. And that's part of the diversification, part of the reason why we don't exclusively invest in equities. The core allocation we make in our hedge fund portfolio is in a fund of funds run by Blackstone. As David Pulver mentioned, fund of funds aren't an attractive option for us in private equity, but we find it somewhat different in the hedge fund universe, that we find that Blackstone can generate value equal to its fees. How do they generate value for us? They use their scale to obtain fee discounts, and so they pay larger fees than we would for individual funds. Their funds include funds that we cannot get access to because they're no longer taking money in. So they invest in certain funds that are really attractive that we can't invest in. And then they also offer us diversification that we just couldn't achieve on our own, just given investment minimums. And so our core allocation within flexible capital is in Blackstone's fund of funds. But we do invest a portion of our hedge fund allocation, our flexible capital allocation, into individual hedge funds. When we're doing that, we're looking at highly seasoned managers with long-term track records. And so you can see we've invested with DK, whose head spoke at a previous annual meeting. We have investment with a firm called Lakewood. And then we recently replaced the manager and have added Baupost to our hedge fund portfolio. And so again, core allocation to fund of funds, but investment in 3 other hedge funds to round out the portfolio. Saving the best for last, I'm in charge of our fixed income portfolio. In addition to the managed pool, we have a fixed pool with 50 million of assets. And in terms of the calendar year to date, it's our best performing pool, and it has positive returns to date. And so what we're trying to do in fixed income is we're trying to preserve capital as our #1 objective, and then we're trying to earn modest returns as our #2 objective. And so in the fixed pool, we're achieving that goal. Not every month do we have positive returns, but over the course of the year, we've had positive returns. In addition, the fixed income subcommittee is responsible for about 13% of the managed pool. In both the fixed pool and the managed pool, we have a core allocation to separately managed account managed for us by Fiduciary Trust, which is part of Franklin Templeton. That account is intended to be very low risk, again, focused on preserving capital. And so it's short duration, and it's only investment grade securities. And so that's our core allocation. But we do allocate to some other fixed income strategies to try to add some return without taking undue risk. And so in the managed pool, we do have investment in bank loans in addition to the fiduciary trust account. But overall, we find that we're achieving our goal in flexible capital. We're achieving our goals in fixed income, and we're very happy with both allocations. So with that, I'm going to turn it over to Peter.
Unmute myself. I will say thank you all, David, Michael, Jeff, for your presentations this evening. Very, very informative, but also, for your work over the years, through the years. As you can hear, I mean, these folks take this very seriously. They spend a lot of time as subcommittee heads, attending committee meetings, doing diligence on managers, follow-up, speaking with prime Buchholz. So we as a community are very, very fortunate to have this talented group and the rest of the investment committee working so diligently for all of our benefits. So thank you all. Actually don't see any questions from the audience, but I just wanted to conclude with a couple of things. First, I also want to thank McCall for really setting this up. She's done a great job so far. I don't want to jinx the last couple of minutes of the technical side. And the rest of the staff as well for organizing it. As I said, I'm very pleased to see that we've had a record turnout for our meeting. So I hope that it was successful on the recipients' end. And I want to thank, of course, Howard Rabner, because none of this would happen without Howard, who really keeps the investment committee going, helps us make sure that nothing falls through the cracks, communicates with Prime Buchholz, et cetera, organizes our meetings, and keeps us on track in so many respects. So thank Howard. And then the last comment is just to reiterate, these are tough markets. And I know sometimes, people may look at the returns and say, well, you lost money. Although put fixed income aside, as you heard from Michael, that's the one place where, you can eke out modest positive returns. And it's scary sometimes. And when you see, markets as we've seen for, a few days here, the volatility of, up or down in the equity markets, 5, 6, 8+% in a day. And you see, almost a panic. It's easy to say, well, gee, that's not for me. And look, and for some, it's not. But, what we try to do as a committee, and I think you can hear as a portfolio, withstand that kind of volatility. And, equity markets are such that you're not going to be able to enjoy the benefits of a kind of normal progression over a long period of time of appreciation and modest downside risk without going through some periods, and whether it's coronavirus this year, or it's the financial crisis, or it's the emerging markets crisis. And there will be more crises. It may not be coronavirus, but there will be other periods of time when the markets go down 10 or 15+%. And it sounds like, and it feels like the world's coming to an end. And we all have, a little bit of trouble sleeping and wonder what's going to happen tomorrow. And there are some who just say, you know what, that's not for me. And I don't want to have any exposure to that. But if you take a longer term perspective, as again, I think our portfolios try to do, and the historical record demonstrates that, you can feel within the context of that kind of exposure that we have a portfolio that is not easy to replicate, whose goals and objectives are to have substantial appreciation, capital appreciation over longer periods of time, not with zero risk, but with less risk than owning an index fund, or less risk than just owning an S&P 500 fund, where there is no active management and you are completely subject to the whim of whatever the larger cap names or whatever your index holdings are. So again, whether it's private equity, real estate, hedge fund, the public equity side where we're looking at active managers, I think that creates a unique proposition, and hopefully a very profitable and sound proposition for you and all of our investors. So with that, I want to say again, thank you very much. Thank John. If you have any follow-up questions, please contact any of us, McCall in particular. And we wish you all a good evening, and stay safe and stay healthy. Thank you very much.